Welcome back to The Explainer. We're diving straight into a totally transformed housing and investment landscape for 2026. You know, for generations, the golden rule of home buying was super simple. Save up, put 20% down, and whatever you do, avoid paying private mortgage insurance. But what if I told you that in today's specific, high-rate, high-return environment, rigidly following that old rule might actually be the single biggest financial mistake you could make? Yeah, we're going to challenge that deeply ingrained myth right now.
Seriously? You've got to ask yourself, is your 20% down payment actually a wealth trap? I know, it sounds totally counterintuitive, right? We've all been taught that equity is king. But dumping a massive chunk of liquid cash into a down payment just to avoid a relatively small monthly fee might be creating what financial analysts call dead money. You're essentially locking your capital up in a highly illiquid asset, which literally starves your broader portfolio of the explosive growth opportunities that are out there in the market right now.
To really grasp the massive opportunity costs here, just consider the number 12 to 15%. That's the projected S&P 500 total return for this year alone, straight from major institutions like Goldman Sachs and Morgan Stanley. They're pointing to robust corporate earnings and some massive artificial intelligence productivity gains driving the market. So when you take your hard-earned cash and bury it in the walls of your house, you're walking away from double-digit compounding returns.
So here's our roadmap for today's explainer. We'll start by unpacking the 20% down trap, then look at the hidden dangers of return on equity drag, and compare your mortgage debt directly against equity yield. After that, we'll get into the new OBBBA tax optimization strategies and wrap it all up with your 2026 strategic blueprint.
All right, Section 1, the 20% down trap. Let's rethink down payments.
The old paradigm tells us to always put 20% down so we avoid private mortgage insurance, or PMI. But look, with today's mortgage rates sitting around 6 to 6.5%, liquid cash is incredibly precious. Handing over hundreds of thousands of dollars up front just to hit some arbitrary percentage is actually a really dangerous move when you look at how money behaves in different environments right now. National home price appreciation is projected to be pretty modest this year, only around 1 to 2%. Meanwhile, basic high-yield cash and money market accounts are generating 4 to 5%, and as we just saw, the S&P 500 is looking at 12 to 15%. If you put 20% down, all that cash immediately drops down to earning that meager housing appreciation rate.
And this brings up a fantastic point from the mortgage reports. A lower down payment that gets you into home ownership sooner often beats a larger down payment that delays purchase by years. Think about it. If you're sitting on the sidelines trying to save up that massive 20% chunk, you're paying rent. And rent has exactly zero return. Delaying just means you're missing out on immediate property appreciation, even if it's modest, and you're completely missing out on the powerful tax benefits of actually owning real estate.
Moving right along to Section 2, the danger of ROE drag. Let's talk about getting trapped in your drywall.
Okay, so getting into the actual mechanics of equity, we really need to look at what happens when your net worth gets trapped inside your house. Wealth managers call this ROE drag, or return on equity drag. Think about it like this. Say you have a $1 million home with no mortgage, and it appreciates by 2% this year. Well, your $1 million in equity only earned 2%. Sure, it's safe, but unless your drywall is somehow secretly printing $100 bills, it's effectively dead money from a growth perspective. It drags down the total performance of your entire financial portfolio simply because that exact same capital could be generating vastly superior returns over in the equity markets.
Now for Section 3, mortgage debt versus equity yield, where the math completely destroys the myth. Let's pit the true cost of your mortgage directly against the stock market. There is a massive positive arbitrage happening here. When you factor in tax deductions, which we're going to cover in just a second, your effective after-tax cost of borrowing at today's rates isn't really 6.5%. It's actually somewhere between 4.2 and 5.2%. Now, compare that effectively subsidized debt directly against the 12 to 15% you could be making in the S&P 500. The spread between what your debt costs you and what your cash can earn for you is mathematically huge. Let's ground this in a real-world scenario. Imagine a $500,000 home purchase held over 10 years. A traditional buyer putting $100,000 down, that's the classic 20%, has absolutely zero capital left over to invest. But a strategic buyer who puts just 3.5% down, which is $17,500, can invest the remaining cash difference straight into the market. Even after paying a higher monthly mortgage and monthly PMI, that strategic buyer ends up with an almost $90,000 wealth advantage over 10 years. I mean, the math is just undeniable.
Which perfectly sets up Section 4, OBB tax optimization strategies.
These strategies build perfectly on the recent legislative changes brought in by the One Big Beautiful Bill Act, or OBBBA, taking full effect for the 2026 tax year. Regardless of where you stand on the politics of the bill itself, the financial reality is that it fundamentally rewrites the tax code to favor leveraged homeowners. The bill made the $750,000 mortgage interest deduction cap permanent. It dramatically expanded the state and local tax or SALT deduction. And, incredibly importantly for this specific strategy, it fully reinstated the deductibility of private mortgage insurance. Basically, the tax code is heavily subsidizing your leverage by letting you write off massive amounts of interest and officially making your PMI tax deductible again.
This new $40,000 SALT limit is an absolute game changer. Previously, it was capped at $10,000. Which severely penalized affluent buyers in high property tax states like California, New York, or New Jersey. But now with a $40,000 limit, you're strongly incentivized to itemize your taxes. This allows you to shelter huge amounts of property and state income tax that used to just be lost money.
So because of these combined OBBB deductions, the interest, the SALT expansion, and the PMI write-off, you aren't actually paying that headline 6.5% mortgage rate. If you're a high earner in the 35% tax bracket, your effective after-tax rate drops sharply down to roughly 4.23%. This widens that positive arbitrage spread against the stock market even further. You're essentially borrowing at an effective 4% to potentially make 12% or more. It's wild.
All right, let's bring it all together in Section 5, your 2026 strategic blueprint to maximize your wealth.
So how do we actually synthesize all this macro data and tax changes into an actionable execution plan? Well, here's your 4-step blueprint for 2026. Step 1, put down a minimal amount, somewhere between 3 and 10%, to preserve your liquid capital. Step 2, aggressively invest that retained cash difference right into the equity market to capture those high yields. Step 3, work closely with a CPA to heavily itemize all those new OBBB deductions to drive down your effective borrowing cost. And Step 4, just remain patient, let your investments compound, and simply refinance the mortgage when rates eventually drop down the line.
To finally put the nail in the coffin of the 20% down myth, we just need to look at the cost-benefit analysis. Yes, obviously, putting less down means you have to pay PMI. But let's say on a $400,000 loan, your annual PMI cost might be around $2,800. If you kept $60,000 in your pocket instead of dumping it into the down payment, and it yields a conservative 10% in the market, that cash generates $6,000 a year. You really stop fearing PMI when you realize it's just a minor cost of doing business that enables you to make thousands more by keeping your capital liquid and working for you.
It really comes down to this core idea. True optimization of a mortgage is less about getting the absolute lowest rate and much more about minimizing the total cost of borrowing while maximizing your return on equity. True financial sophistication in 2026 is all about managing leverage and liquidity. It is definitely not about draining your bank account, losing your safety net, and starving your investment portfolio just to hit some arbitrary 20% threshold set by a previous generation.
As we wrap up this explainer, I want you to take a hard look at your own portfolio. Are you managing your home strategically as a leveraged financial asset, or is your wealth quite literally trapped in the walls, suffering from ROE drag? The rules of wealth building have fundamentally changed. If a 20% down payment is costing you almost $100,000 a decade in lost returns, what other golden rules of finance are secretly draining your net worth? Keep questioning the old rules, keep analyzing the data, and we'll see you in the next explainer.